Hey you! Welcome back to the channel. As you can probably tell from the title of this video, in today's episode, I'm gonna go over tax tips and specifically year-end tax tips that will save you on your tax bill. If you ever wondered what you could be doing now to save on your taxes later, or just curious about some of the year-end tax planning strategies that the wealthy use, then this video is for you. Now, I know the pure thought of taxes is not exactly fun. I mean, just about no one gets giddy around the idea of filing and paying their taxes, right? Yeah, I didn't think so. But what is more fun is figuring out ways to reduce your tax liability and owe less taxes the next time you file. The key to successfully accomplishing this is doing so before the end of the year. So today, I'm going to break down 5 year-end tax tips that, if implemented before the end of the year, will save you a lot in taxes. I should also mention that everyone's situation is different, and it's important to consult your CPA to assess if these strategies are right for you. Hey again, I'm Crystal, CPA and co-founder of Life Accounting. We are an accounting firm dedicated to helping small businesses with their financial and tax needs. Now, before I dive into this video and give you year-end tax tips that will help you save in taxes, please give this video a thumbs up and subscribe to our channel if you haven't already so you don't miss out on future videos. Sound fair? Okay, let's get started. Year-end tax tip number 1 is to contribute to your retirement account. I actually can't emphasize this tip enough. I actually want to scream it from a mountaintop. And actually, I will. Contribute to your retirement account. It'll save you in taxes. Seriously, if you haven't already done so, max out your annual contributions to your 401k or IRA account. For 401ks, you can contribute up to $19,500 in 2020. For IRAs, you can contribute up to $6,000 in 2020. This tax tip is actually twofold. For one, you're saving towards retirement, something everyone should be doing. And 2, the contributions you make to these retirement accounts are, drumroll please, tax deductible. Usually 401k contributions are made with pre-tax dollars, so even though you earned this income, it's not actually taxed yet. IRA contributions are not made through an employer, so it is not pre-tax income, but the contributions made are tax deductible and lowers your taxable income. To figure out your tax savings, you will need to multiply your tax rate by your retirement contributions. Also, this tip is a little different since the IRS gives you until the filing deadline to make these contributions apply to the current year. So you have a little after the year end to take advantage. Year-end tax tip number 2 is to sell losing stocks. If you have some losing portfolio investments, sell them before 12/31, especially if you think they won't come around. Or even if you do think they'll bounce back, you'll be able to buy them after 30 days. This strategy is actually called tax loss harvesting. Completely legal and legit. You basically sell losing stocks, get the tax break, and then buy back the stock after 30 days at the lower losing price. Definitely look into this strategy more if you think you could benefit from it. But essentially, by selling your losing stocks, you're able to write off up to $3,000 per year in capital losses, or you could use those losses to offset any capital gains and lower your taxable income. If your losses are more than $3,000, don't worry, you're able to carry forward any excess losses to the following year. Year-end tax tip number 3 is to accelerate your business expenses. With this tip, I'm not saying to go out and buy $10,000 worth of unnecessary business equipment or supplies. Just no. Instead, I'm saying if you were already thinking about buying a new business computer, for example, do it before December 31st. Or if you're planning a business trip next year, book it before December 31st. Don't wait until the new year to make business purchases. This way, you can claim the deduction in the current tax year. The more business expenses you can claim, the better. The same is true for business asset purchases. For the sake of simplicity, let's assume a business asset is anything purchased over $5,000. Well, the IRS doesn't necessarily let you claim assets this large as a deduction, but instead you can claim the depreciation expense on such items. Still a great benefit and opportunity for you to lower your tax bill. Year-end tax tip number 4 is to defer income. Similar to tax tip number 3 with accelerating your expenses, you should also consider deferring or pushing back your income to the new year. Why? The more income you receive in the current year, the more taxes you'll have to pay. So if you have invoices that need to be sent to your customers in December, just wait until January to send them and defer that income. The same is true with winning portfolio stocks. If you see a particular investment doing well, you might consider waiting until January to sell and realize those gains. You could even ask your employer to postpone your year-end bonus to January or February. That way, you'll realize the income after the year end. Keep in mind that your employer might be hesitant to do this because that would also mean that they would have to postpone the write-off. Now you might be wondering, does deferring my income really save me in taxes if they are claimed in the next year? Won't I just end up paying tax on it later? The answer is yes. Deferring income saves you in taxes in the current year, and yes, you will end up paying taxes on it later. However, in tax planning, there's a concept for deferring income for as long as possible, because the longer you can postpone income, the longer you can hold off on paying the tax. And the longer you can hold off on paying the tax, the longer that money is in your pocket. This is a good thing. Why? Because there are other things you could be doing with that money today, and that gives you value today. Also, with continuous planning, you could potentially be in a lower tax bracket when it's time to realize and pay tax on that income. Year-end tax tip number 5 is to donate to charity. This tip is useful if you itemize your deductions as opposed to taking the standard deduction. If you normally give to charity or your church, consider making an extra donation before the end of the year. Make sure the organization that you give to is a qualified charity and you receive a receipt for your donation. The good thing about this deduction is that you can write off monetary and non-monetary donations. So if you give clothes or furniture away, you can get a receipt from the charity showing the value of the items donated. There you have it. These were the 5 year-end tax tips that almost anyone can implement and use to lower their tax bill. Again, make sure to consider maxing out your retirement contributions, selling losing stocks, accelerating business expenses, deferring income, and donating to charity. Which one will you do this year? Why don't you comment your thoughts in the comment section below? I hope you enjoyed this video, and I'll see you in the next one. Bye for now.